Hey guys, Dave Keller here with Market Misbehavior. We're here on Fed Day on July 31st, 2019, day when the Fed announces potential change in interest rates, and this afternoon got the word of a 25 basis point cut in the Fed funds rate. You know, I'm often asked about technical analysis or charts and how applicable they are on a day like today, on a big Fed day when there's a huge macro announcement that is clearly going to move markets. And so, how important could charts be on a day like today? Well, let me start with a quote from Benjamin Graham, and I'm totally paraphrasing, but he basically said in the short run, the market is a voting machine. In the long run, the market is a weighing machine. Meaning, in the short run, in the short term, markets tend to be a popularity contest, a voting machine. They're based on the collective, people voting with their money, voting with their feet. Identifying where they find value, where they find opportunity. That's what causes prices to move in the short run. In the long run, though, stocks eventually trade to the fundamental value, the intrinsic value, right? So over the long term, it's a weighing machine based on the strength of the company and the potential of the company. Take it a step further. If you actually look at the data in equity markets in the U.S. going back decades and decades, so multiple cycles, multiple business cycles, you'll find that in the very short run, if your time frame is a couple days to a couple weeks, the markets tend to actually mean revert, meaning you're better off buying weakness and selling strength and betting on that short-term mean reversion. If your time frame is more intermediate term, or what I would call a couple months to a couple years, you should be a trend follower. Again, based in a vacuum, all else being equal, based on the data, it tends to be a relative strength world, meaning you're better off buying what's working, buying strength and expecting that to continue, and also selling weakness and expecting that to continue to underperform. So those first two, the weaker short-term or short-term mean reversion and the intermediate term trend following, is why most institutional quantitative models have a momentum factor, and it's usually something like 12 minus 1, meaning 12-month returns minus 1 month return. So what will score the best is something that's in a good long-term trend, but a weaker short-term trend. That's why. If you're very long-term, if you're out a number of years, then it goes back to mean reversion. It's back to the business cycle and companies and sectors coming in and out of favor based on the overall movements in the economy. So depending on your time frame, that's kind of what the data supports in terms of what you should be doing, mean reversion versus trend following. But going back to the initial thought, what about a day like today? And some would say if it's a big earnings release or a Fed announcement or something like that, charts have no purpose, right? Because it's no longer based on just the fear and greed of investors. It's based on this big macro thing, this news event that's going to change the world. I would argue a day like today is the best time to be using charts. I would say you need to be using them more than ever. And the reason is this. The market is a voting machine in the short term, meaning if you want to understand how people are reacting to a Fed announcement or the phrasing of Fed policy or the way that the news disseminates or what people's expectations are around interest rates or gold or bonds or equities, the charts are what are going to tell you the collective insights or the collective perspective of all these different investors. So we're all panicking or euphoric or desperate. We make the trades as a result of that emotional condition, our reaction to what's happening. The charts will reflect that, the collective insights of all these different investors. So if you want to understand how people are interpreting the news flow that's coming out, will a chart predict what a news event will be? Probably not, right? And I would argue, and a lot of times there's no way to predict that with any real certainty. But what the chart is absolutely helpful for is to gauging the reaction, understanding when a stock or a market gaps up or down as a result, what happens after that, how quickly does it recover, does it reverse back to its previous value, or does it continue on? All of those questions are technically oriented questions, chart-oriented questions to help you get your head around people's reactions to a big event like the Fed announcement today. If this sort of thinking of investment process, decision-making is of interest to you, I hope you'll check out some of my other videos on the Market Misbehavior YouTube channel. Thanks so much.